All right, warm welcome everybody to a brand new week as well as a brand new month. Now, if this is the first chance that you get out of looking at the chart since Friday, you are in for quite a surprise. We had big moves across the board on Friday. The earlier solid upside that we saw in equities and the dollar for the majority of the week all came to a very abrupt end on Friday. Pretty ugly close for both the dollar as well as equities, mostly on the back of a very disappointing US jobs report. Now, let's take a look at some of these markets in a bit more detail. Now, last week, equities, look, everything started off pretty good for them. We had an initial bout to the downside on the FOMC policy decision, where the Fed obviously came across a little bit more hawkish than what the markets had anticipated, with Fed Chair Powell not really confirming the market's expectations of a September cut, pushing back a little bit against that. That saw equities push lower initially, but earnings from the likes of Microsoft and Meta eventually saved the day. We saw all-time highs for the US 500, all-time highs for the NASDAQ. Everything looked hunky-dory. And then, of course, on Thursday, everything started to peel off a little bit. We had earnings coming out from Amazon, which it didn't basically live up to the hype like we saw from the likes of Microsoft and Meta. I mean, if you take a look at the chart, specifically for Amazon, I mean, it's pretty ugly, right? 8% push to the downside. Quite an ugly move that we had on the back of that one. There was also some additional concerns for equities on Thursday, with President Trump basically coming out writing letters to Big Pharma, forcing them, or threatening them rather, to lower prices. The markets didn't like that one bit, but obviously, Friday, we saw a big extension in those moves to the downside, mainly on the back of the US jobs report, which we'll get to in a second. I mean, the S&P was down well over or close to 2%. NASDAQ down well over 2% on the week from the high to where we closed on Friday. More than a 4% move to the downside. So pretty punchy stuff. And then, of course, there was the US dollar. The dollar did fairly well for the majority of the week last week. We were able to break above that key level of resistance around that 99.50. Initially, at the start of the week, the dollar was buoyed mainly on the back of that trade deal between the US and Europe, where the market saw the deal as largely positive for the US, but not so much for Europe. We had European industry leaders voicing their concerns about it, saying the deal only favors the US. They're going to be paying higher tariffs, which will mean, or obviously, tariffs raised on those products coming into the US. And they're already struggling to cope with the uncertainty and the lack of growth from the recent few months. So that was a big negative for the euro. We saw euro dollar. I mean, take a look at this chart. Just ignore the move from Friday, which we'll touch on in a second. Big rush to the downside last week on the back of that news. We also, going into on Wednesday, we had very solid GDP data. GDP printed at 3% for the US. We had core PCE prices pushing up as well. And then, of course, the Fed came in more hawkish than what the markets had anticipated. Now, unfortunately, then Friday, NFP saw a huge, nasty reversal in the dollar index breaking back below that key 99.50. The likes of the euro dollar pushing back all the way from 114 up to 116. Two big figure moves there. Take a look at the dollar yen. This is one that I traded on the back of the NFP report. Just a massive flush to the downside. We were trading close to 151 coming into the session on Friday, and we ended at 147.50. That's a monster move. I was able to bank a nice 1 to 5 trade there on the dollar yen, so very happy about that. But take a look at how far the markets even dropped after I got out, so I definitely left a bit of profit on the table there. But overall, just a very ugly move to the downside, especially because after the jobs data, we also had the ISM manufacturing data showing in a pretty big drop down to 48 as well, which just exacerbated that move to the downside. So what exactly was in the US data that freaked everybody out so much on Friday? I mean, take a look at this data. Now, instead of the expectations of 110,000, the payrolls only increased by 73. The unemployment rate ticked up as the markets anticipated to 4.2. And we actually had a bit of a move to the upside in earnings. So at face value, you can look at that and say, why on earth was the market so freaked out? And you would be correct to say that, because the focus wasn't on the headline data or the data we see here. The focus instead was on massive downside revisions that we had for the prior month's data for both May as well as June. Now, just to put this into context for you guys, let me show you guys what we were looking at on Friday. Now, on this chart over here, we have the non-farm payrolls first estimate, right? So that's the one that we always get. Now we can see that for May, we came in at a very respectable 139,000. For June, we came in at 147. And obviously we had that dip to the downside on Friday. Now, this is the first estimate data, but obviously this data, by the time that we get the data on the first Friday, normally the first Friday of every month, the BLS, the labor statistics of the United States, they don't have all of the data available to give us the right number or the full number or the complete number, which is why we always have revisions. Now, normally the revisions aren't very big. You can sometimes have very big ones, but normally they are, within a certain range. It's not scary revisions for the most part, until, of course, the data that we had on Friday. I mean, again, just to put this into perspective, now I'm going to add on the revised data that we had for NFP and take a look at this huge difference. Let's just increase the size here a little bit. Again, May was first estimated at 139,000. On Friday, that was revised down to 19,000. That's ugly, right? The 147 from June was revised down all the way to 14,000. That is crazy low numbers. That means that almost all of the job gains that we thought we saw back in May and June was wiped out. And job creation over the last 3 months have basically been averaging just 30 or 35,000. So how on earth could the BLS get this data so wrong? Well, I mean, we had President Trump very angry at the revisions. He vented basically saying that it's corrupted data. The numbers have been made up. The numbers were politically motivated. He even said that he's going to fire the chief of the BLS. Now, again, just to put things into well-needed perspective, these revisions, look, they are pretty freaking bad. I don't disagree with that. But a lot of this isn't because of the BLS and because they're corrupt, but because of the very low survey response rates that these guys have been getting to their surveys, right? The initial collection rates have basically slipped 10% from all the way from 70 pre-COVID to down to 60%, meaning there's less companies are responding to the data and even less is responding in time. So that means that by the time we get the data, it's going to be bound to get big revisions. So the drop in response rates means that big revisions, firstly, are to be expected. And that is, part of the reason why making rash decisions over just one job sprint is never a wise choice. But despite that, the data that we got with the revisions does show us that the labor market has been a lot weaker than most of us has been thinking over the course of the last few months now. Now, even though it's easy to get overhyped by just one release, even if it is a monster one like this, we always have to try and look at things a bit more objectively rather than subjectively, because there will always be the optimists and the pessimists when it comes to the data. You will basically see whatever you want to see in the data, and I am normally guilty of this because I tend to be leaning more towards the optimistic side, so I try to find the positives, especially when it comes to the US economy. But at face value, these revisions are ugly, right? Even for an optimist like me, I look at 19 and 14. That's really bad data. Large revisions, bad data. Now, we do need to be careful because we have had previous times when we've had big revisions, which didn't necessarily lead to a big slowdown in the labor market. There was a couple of false signals. Now, if I just show you one very good example of this, is take a look at initial claims data. This is one of those data points where if the US economy or the labor market rather, was really slowing down massively, you would expect initial claims data to be jolting to the upside. You would expect this to create new cycle highs almost every week as the labor market starts to weaken. We haven't really seen that. Now you can argue, okay, fine, but this is looking at things at a very short scale. You have to look at it at a slightly longer time frame. But even if we do that, if we look at the 1 year percentage change of something like initial claims data, you can see that normally speaking, every time that we get above about 25% year over year for claims data, almost every time that has happened, the US economy was already inside a recession. Take a look at where we're trading right now. We are nowhere near those scary levels that we would normally expect to see from the labor market, from initial claims data, in this type of environment, right? If the labor market is really slowing down massively, you would have expected that to be moving in the right direction, which is higher. We're not seeing that happening. So this is obviously just one thing that we're looking at, just like those who are looking at the NFP is also just looking at one thing, right? So we can't say that, oh yes, everything is collapsing by just looking at these revisions. They are big and they are ugly. But it doesn't mean that we are already in a recession, right? People are already saying that, oh boy, right? The end is here type of thing. I think it's way too early. It's way too rash to make those types of connections in the data. It's 1 month worth of data and revisions. We might get more revisions coming out, right? So we just need to be a little bit careful with this. But the bottom line is that even regardless of this, what this data does tell us is it gives us a very clear picture of where the trend for the data is going, right? Whether we look at the revised data or the unrevised data, the trend is lower. And in this one, we can clearly see once again, the trend, that's not the one, sorry, here we go. You can see the trend is moving in the wrong direction. The labor market is definitely slowing. It's not crashing, but it is slowing. And these revised numbers have basically just shown us that even though we know or we knew that it was slowing, it's now slowing at a much faster pace than we previously thought. And that is what the market's real concern was going into that data or coming out of that data on Friday. Also, the timing of this print is also to blame for the monster reaction that we saw in equities and the dollar. Because remember, the labor market wobble is significant because just last week, just 2 days before we had this data, we had the Fed coming out who were very reluctant to ease rates. And I mean, to be fair, they were reluctant because they probably saw the numbers that we initially saw on the headline, right? They probably saw 73 and 4.2 and thought to themselves, you know what, this is no reason, because you have to assume that they have access or had access to the headline data before they made their decision, right? It would be very, we've heard from them before with things like CPI prints where they get the data a few days before, if the meeting that they have is just before key data, they will be getting that information before the meeting, right? So because they came out pretty hawkish on Wednesday, you would assume that this is the data that they saw. Okay, well, 73, look, it's slowing down, but it's not crashing. As long as the unemployment rate is staying stable at around 4142, everything is good. We don't have to worry. But I'm sure, right, if the board members saw those massive revisions, then I am sure more of them would have opted for a cut, or as a bare minimum, more of them would have been more keen to very clearly open the door for a rate cut in September, which of course we didn't get. And I mean, Fed Chair Powell, he downplayed labor market weakness by pointing to a still low unemployment rate, which is again exactly what we got. So you can't blame him if this is the data that he saw. If he didn't see the revisions, which I think he didn't, then maybe he would have felt a little bit differently. But the main focus point is that because the timing of this happened directly after this meeting, that is also to blame for the massive reactions that we saw. I mean, take a look at this. This is looking at interest rate expectations. So what we have here is we have the October contract for Fed Fund futures and the December contract for Fed Fund futures. Now, take a look at how the whipsaw happened, right? On Wednesday, rates markets pushed up. So expectations for the federal funds rate moved higher because the Fed came in more hawkish, right? Markets doubted whether we're going to get a cut in September. Then come Friday's jobs data, boom, everything pushes lower. The markets have now almost completely priced in a cut for September, and they have more than fully priced in a cut now for December. I mean, if you take a look at these two tables. Let me show you what we have. This one on the left is interest rate expectations before NFP, and on the right is after NFP. Now take a look at this Fed column over here. You'll see that by the end of the year, the market was only pricing in about 36 basis points of easing. That jumped to 65. So the markets are actually pricing in a small premium of a possible 50 basis point cut. Now, it's important for us to remember one thing. Interest rate expectations are almost always too bearish or too hawkish compared to what actually happens. Remember that just a year ago, if you take a look at this data that we had, remember back in July last year, let's take a look at the first estimate data. We had that big drop to the downside in jobs data. And at that time, the markets went absolutely ballistic. Everybody thought that the end is here, it's Armageddon. The markets at that stage were pricing in well over 2% worth of cuts for the Fed in a very small time frame, like 10 or 12 months. That didn't happen because it was a false signal. Now, however, that scare was enough to see the Fed kickstart their cutting cycle, right? They did cut 100 basis points worth of easing after that happened, but it was a false signal. So the bottom line with all of this is that we need to be very careful here, because what happens now? The markets will now want answers from two places. The first one will be, what does the Fed have to say about this data? And the other one is, what does the actual incoming data tell us as well? Remember, even though the markets are now fully convinced that we get a cut in September and fully priced for a cut in December, we do still have one jobs print and two inflation reports before the September meeting. That means that if the data between now and then surprises massively to the upside again, right? If we get very hot inflation data, or if the next NFP sees a big rebound in those revisions, then all bets for a cut in September will reverse again, drastically. But that is only coming up in the next few weeks. What about this week ahead that we're going into now? For this week ahead, for the very short term, the focus will be on what the Fed board members tells us. Because we have a whole shipload of them giving us comments this week, and I would expect for the majority of this week to even see a couple of additional Fed speakers coming online as well, telling us their view, because the markets will want to know. We did hear from from Fed's Hammock on Friday. He basically downplayed the weak NFP data. He said that it's just 1 month worth of data. We shouldn't, overreact on it. We also heard from Fed Williams over the weekend. He basically said that he's going to be keeping an open mind. He's not committing to a cut or a hold. So for this week, watch out for Fed speak. If the majority of them strongly hints towards a cut for September, and maybe some of them even opens the door to bigger types of cuts, like 50 basis point cuts. If that happens, what could we expect to see? We would probably expect to see further downside pressure playing out for the likes of the US dollar, and vice versa. If the bulk of them should come out and push against a cut in September, saying that, hey, let's not be rash, let's not make up our minds too quick, we need more data, a cut is not guaranteed, then obviously that could see some of those moves reversed in the US dollar. We'll look at a couple of levels first. The one area where it's going to be very tricky to know how the markets will react will be equities. Why do I say that? Because think about it this way. If we know that the data is bad, and the data that's bad should be bad for equities. But at the same time, if the markets are pricing in a higher probability of a cut, which they are, or cuts, which they are, then that should actually be more positive for equities again. So you've got both positive and negative things playing out in equities right now. Earnings is still pretty good, even though Amazon disappointed. Majority of earnings is still positive. If the Fed does cut rates, that should be good from a rates point of view. But obviously, if the data continues to deteriorate, that isn't good for equities, because that means future earnings will suffer, because it's not good for growth. So it's a little bit of a weird one. I suppose the simplest way to look at equities will just be to look at this from a broad macro point of view. I believe that the markets are still broadly bullish from an equity point of view. That means waiting for key levels to look for some opportunities to re-engage back to the upside. But there's obviously a few key levels we need to watch. For the S&P specifically, we are currently sitting on a huge level of support, the same one going back all the way to the earlier part of July, which was range bound before we had that break to the upside. Beautiful price action here, by the way, as well. Range bound between 62.20 and 62.90 until we broke out, retested, and then pushed to the upside. Now we are revisiting right back towards those prior range lows. So what will the play be? If we do break below these lows, the next key stop the markets will be watching will be the prior all-time highs going back to February. That comes up close towards that 61.40. If that level should fall, next key stop will be those highs going back to June, coming up around that 60, let's call it the 6,000 level flat. So key levels to watch to the downside in case this level breaks. Alternatively though, if the markets do start to get more positive about the idea of cuts, or if earnings in the weeks ahead tells us that we don't have to worry, or the week ahead tells us that we don't have to worry about just one company, which is Amazon, obviously a break back above that range would give the bulls an opportunity to maybe aim back up towards the prior all-time highs now around that 64.40. So key levels there to watch for the S&P. What about the dollar? Look, with the dollar index below 99.50, it's going to be very tough for the bulls to get excited about this one until we're able to clear back above that 99.50. Key level right now to watch at the downside would, ugly. It's going to be very ugly, but a possible move back down towards 97.70 is possible as long as we stay below that range. And obviously, if we do break back above this, maybe with Fed members pushing back against the idea of cuts, then that could be something worth looking at as well. I do believe that until we hear from more Fed members, the bias is going to be pretty shaky on the dollar. I suppose it's going to be more shifted to the downside in this week as a result of that data. Key numbers that I'll be watching there for things like the dollar yen. That's obviously been a favorite for me on Friday. Had a very big move to the downside. Was the biggest mover if you compare it to the other major currency pairs. The main reason for that is because of the impact of yields. So if you take a look at the yen, the move in the yen was a 2% move, 2.2% move on Friday. Now, why is yields important for the yen? Firstly, this is what yields did. Massive move to the downside. And if you take a look at this chart over here, this chart shows you the yen index in white versus US yields in purple. Now, we normally have an inverse relationship or correlation between these two things, meaning when yields fall, we normally see the yen move up. If yields go up, we normally see the yen go down. Normally doesn't mean always, right? But normally that's the case. It's a very rate sensitive currency. So if we assume that people will stay concerned about the US economy and yields continue to drift lower, that should be good for the yen. And if we assume the market will stay a little bit more cautious about the dollar, then you would assume a more downside bias for the dollar yen in a week like this. Key level that I'll be watching. I don't want to be shorting this sucker at the lows, right? Because that is just not what I like to do. I like to look for pullbacks to get better levels to get in. So key areas that I'll be watching for possible opportunities will be a move back up towards that prior key level of now resistance, prior support around that 148.50. It's been a key level for this market for a couple of months now. So if we do get a nice retest of that, that could be good for a possible continuation lower. And again, what would make that null and void is if Fed members this week come out and they strongly urge against assuming a cut for September. If we break back above that level, then all bets for me are off, right? Then I won't be looking for shorts again. But until that level folds, that could be a key level for markets to use to just lean back into to look for further push to the downside. And in terms of likes of the euro dollar, look, it's tricky to get excited about the euro after the trade deal because that is still a negative driver for it. But I suppose if this is something that you do like to get in on the long side with, I'll potentially be looking for a same type of strategy, looking for a move back down towards that prior level of support and maybe using that as an opportunity to push back to the upside. Those will be key levels that I'll be watching for the pairs. But again, dollar yen definitely my favorite if I'm looking to play some continuation to the downside for the dollar. For the gold traders out there, big move to the upside in gold as well. Obviously helped, firstly, by the bad US data, which is normally good for gold. It was also helped by the downside in the dollar, the downside in yields, and there was something else that pushed gold higher as well. On Friday, we also heard some news that apparently the US administration has moved a couple of subs around based on something that Russian politicians have said. So that obviously upped the geopolitical risk a little bit. And take a look at gold. I mean, we broke below that key level of trend support. We are right back at that level and right back at that 33.70, which was a key pivot for gold a couple of weeks ago. Not a market that I'm too fond of trading right now, as you guys know, but we are moving up towards a massive level of resistance here. So it's definitely one to watch out for those of you who are potentially trading this. From a pure technical point of view, not looking at the fundamentals right now, any breaks and closes above that potentially opens up a move back to the upside. And obviously, if the Fed officials comes out this week and they are all super positive about the economy, if they're not scared about the recent revisions, if they see very low chance for a cut in September, that could potentially offer some resistance to push back to the downside, of course, from that level. But again, no skin in the game when it comes to that. I would rather be focusing on the likes of the dollar yen. Now, that is just a recap of what happened, why we are looking at more softness for the US dollar, what levels we are looking at for possible leaning back into to get or to take advantage of that. Now, apart from that, we actually do have other things coming up this week. Apart from the Fed speak we'll be watching, it's not going to be massive when it comes to these things, but they are definitely worth watching. We will, of course, be getting the ISM services PMI coming up on Tuesday. Always something that's important to watch. Remember the difference between manufacturing that we got on Friday and services that we will be getting on Tuesday is services makes up close to 80% of US GDP. So if there should come out like super hot, really good data, then that could be a reason, a possible catalyst, right, for the dollar to push up a little bit. But again, we could maybe use that as a catalyst to move the dollar yen back up and use that key level as an opportunity to look to fade that back to the downside. At least that'll be my strategy. I'm not saying that is what you should do. I'm not soliciting you to do anything of that or with that in mind. That will be my strategy. Let me just make that very, very clear for the week ahead. That is what we're watching at, that US services data. Look, we also have employment data coming up for New Zealand. I don't think that's going to be too market moving right now. The markets are still fairly sure that we'll be getting another cut from the RBNZ. So I suppose the sexier trade there would be to hope for really, really good data. And we could potentially use that as a short-term opportunity to trade the likes of the Kiwi dollar higher. Perhaps the one thing that makes that trade tricky is it is a high beta currency, meaning that it is very sensitive and usually correlated to moves in equities. And if equities stay pressured in the week ahead, that might make it difficult for the likes of the Kiwi dollar. But what I do like about this pair is take a look at this huge level that we're trading in around now, right? We've tried to break below it. We're breaking back above, retesting, potentially pushing back up. That looks like a typical false break. Normally one of my favorite chart movements or patterns, if you will, that I like to look at. So I like the setup of this going into the week ahead, but I would like to trade this higher if labor data comes in really, really hot. So that's one to potentially look at as well. Apart from that, we also have the Bank of England policy decision coming up on Thursday. Look, the markets aren't expecting a lot. We are expecting a cut, but that is exactly what the bank told us they're going to do, right? Currently, they've set themselves a pace of 1 cut per quarter, and this meeting is the one that's been priced in for a cut. So the focus won't really be on the cut. The focus will be on what Governor Bailey has to say. Whether the market or whether the Bank of England sees scope for cutting quicker than previously, that's going to be the main focus point. The vote split, as always, will be one to watch as well. Right now, the consensus expects a mixed split, meaning some favoring a hold, some favoring a cut, some favoring a potential 50 basis point cut. So I don't think the pound or the Bank of England will offer us much in the way of volatility unless the bank opens up the door for much faster cuts than what the markets are currently pricing in. If we don't get that, then we probably don't get an opportunity, at least a good one, to be trading the pound in the week ahead. We probably want them to be opening the door for more cuts to really give us an opportunity to trade that. Otherwise, I think it might be a bit of a boring one for the calendar. So with that said, I don't want to keep everybody too long. We've already covered quite a lot. We will obviously be covering a lot of this in the week as the week progresses well. So just watch out for the dollar, watch out for further Fed speak. That's going to be the main focus point, the main considerations for the week ahead. As always, hope everybody will have a fantastic one. And any questions, don't hesitate to let me know.